Hello, Proponomics people, and welcome to the Sunday Supplement Summary from the supplement that was released on the 24th of March 2024. Now, this week I titled it Downhill All the Way, and that was a reference to the fact that the yield curve last week, the yields in the 5-year bond market, spent the week very slowly decaying, and it looked like a very nice little ski slope coming down ever so steadily. And I think in reality, that's the best that we're going to be able to see on the interest rate front. And if we do manage to achieve the perfect deleveraging or the no landing effectively rather than the extremely soft landing, whatever you want to call it, on the back of the pandemic and all the stimulus and all the inflation and all the rest of it that we've been contending with as an economy, I think really that's the best we should be hoping for. And that's currently what the market thinks is going to happen. But yeah, not so sure about that one myself. Let's see. We've still got some nearer term volatility and inflation to deal with. So it was a big week last week in that the inflation numbers were released and we had a Bank of England meeting, and those were the big deals from last week. And I got into those in the supplement. So what's the bit that everybody saw? And look, I'm all in favour of good headlines. I'm not in favour of making bad decisions on the back of good headlines. But nonetheless, I think good headlines are good for the general populace and they help to boost morale, they help to boost spending. And that's usually a good thing unless the economy is running far too hot. So what did we have last week? We had a CPI print of 3.4%. That was down from 4% in January and December. So a big drop. People were expecting a drop down to 3.5. So a bigger drop than expected, only by 0.1%, but it's always helpful. However, what have you got to put this into context with? CPIH, which the ONS prefers as the best measure of consumer inflation in the pocket for the individual consumer, that includes a housing component, and CPIH is still running hotter. It's running at 3.8. Why is this? Well, because the housing cost increases lagged a lot of the other increases in things like energy, for example, and food and fuel and stuff like that that's happened with the overall inflationary situation. They lagged a bit, and that's why they're going to carry on for a bit longer. Now, you've known for a long time we've preferred to look at core inflation as a real measure, because what does core do? It strips out that energy, which is a price that's been coming down and has been bringing CPI downwards. It's actually having a negative impact on inflation at the moment, which is no bad thing when inflation's been so high. But of course, you'll understand that's not sustainable. And indeed, if you look to the medium-term direction of travel for energy, it's all very well going very green and looking at renewables and all the rest of it. But the reality is the energy has cost a lot more money to produce. And as it costs more, who does that hurt? Well, it hurts the poorest in society, apart from anything else. But it hurts growth as a rule. And you could really track back the amount that growth has been lagging downwards with the lack of lowering of energy prices over recent years. And if you think back to the 70s when we were talking about nuclear and having abundant energy and even nearly free energy, that could have done some incredible things for society. Of course, it was a bit of a pipe dream, but there we go. So core down again, down under 5%, but only down to 4.5. Again, it was 0.1 below the consensus as well. So all good, but still over 4%, still pretty dangerously high. Although if you looked at core over the last 6 months, you'd only be at about 1.9% for core CPI, which would be fantastic news. Now, that might be a bit of a false dawn, because I've got some big core figures to drop out of the numbers. But let's see what happens as we continue to contend with the two things that I'm most concerned about in inflationary terms, and those are services inflation, still running at 6.1, so still over that massive 6% number. We really need that below 5 before we start to think about cutting rates, in my opinion, although we do have to remember when the central bankers decide to cut the rates, they are thinking 6 months in advance as they cut those rates. And this would be the first time that a central bank in a cutting cycle in modern times has managed to cut correctly and accordingly and nice and slowly. If they did say one cut per quarter and then continue to monitor the economy and therefore were already injecting pauses into the mixer, that would look pretty good. And they might well get the timing right on that, and they might be right in terms of cutting in June if that's what they decide to do. Although I think they might well be bowing to political pressure a little bit if they do that as well. But I don't think it would be the worst thing in the world to take 0.25% off and see what happens. There's no two ways about it. But services inflation 6.1. Wages, again, what's being reported is 5.6. Well, that includes bonus, but the bonus, as the bonuses that have been dropping out of the figures have been the bonuses that were one-off bonuses from the pandemic. So my argument at the moment is you can't really trust that figure, including bonus number. It's just that's the number we're using because that's the number we've always used. But we do deliver a metric without bonus, and that metric is still up 6.1. So exactly the same as the services inflation number. And you'd expect those two to relatively track, but ultimately wages haven't kept pace, particularly with services inflation, and so they're probably going to persist a bit longer. But if wages go up more than services inflation, because so much of our economy is services, what that means is companies' profit margins are getting squeezed. What happens when profit margins start getting squeezed? Ultimately, unemployment is quite often the result because they try and do the same with fewer people or similar. And of course, services is a very, generally speaking, AI aside, generally speaking, very top heavy in terms of the people that are used in services production. So 6.1 for both of those, for me, is a good reason not to look to cut the rates yet. By the time we get to the next Bank of England meeting, we'll only have had one more data release, which will be data from 2 months before. So we're not really going to see a major league difference in what the central bankers are putting into their decision-making framework, I don't think. So it'd be very unlikely for us to have a cut at the next meeting, less than 10% likely in my book. But a cut in June is perfectly possible because there would have been two more data releases after that between those two meetings rather than one. So much more to consider. And all the smart money says that CPI is going to go downwards potentially quite significantly over the next 2 to 3 months. And that's because, again, that energy price is still continuing to drop. The latest price moves don't really kick in until April's price cap reduction, which is in the tune of about 15%. So that's a big deal for households that have been massively overpaying for their energy. But when you go right deep dive into that, most of those energy price, the drops have now really been baked into the system. So the gas price, I heard a stat the other week on a podcast that said the gas price going to where it did in the UK was the equivalent of oil going to $1,000 a barrel. So that gives you an idea of just how expensive gas had got and how exposed we are to importing stuff that we use to keep our homes warm, run a lot of our businesses, and also generate 40% of our electricity. Massively overexposed in that department. So we have this huge spike up, and then we're on the way back down. And the point is, we're nearly at the bottom of that downhill slope. You compare that to somewhere like the US, where they didn't really deal with massive spikes in pricing and stuff like that. Their CPI didn't go as high, but they touched 3% in the middle of last year, and they're struggling to get below that 3% number now. We're more likely to have way overshot because they only went up to about 7.5. We went up to 11.1, if you remember, in terms of inflation. We're then likely to undershoot as that energy price drops out and the prices have been coming down so much. So we'll go below their 3% low, but we're likely to bounce off that bottom as the energy contribution to inflation reverses again as we get towards next winter. And of course, what we haven't had for years is a cold one, which really impacts the price of gas. And that's very little talked about. Now, in the times of record temperatures every month that don't even get talked about anymore, you could be lulled into a false sense of security thinking we don't get cold winters anymore. But what you've seen with climate change is, apart from anything else, you tend to get more extremes. You don't tend to get just hotter times all the time. You get much hotter parts, like we have the 40 degrees in the UK. You're also more likely to get much colder parts as well. We just haven't had one of those blasts for a few years. Hopefully it's not this winter coming, but that would be inflationary in itself. So a little bit on growth from this week. So talked about growth a little bit because we'd returned to growth and that the central bank have been taking that into account in their Monetary Policy Committee decisions. And then the PMIs, Purchasing Managers Indices, still looking good, still above that 53 on services, although it has clipped back a little bit. So we're not roaring forward on the services side, but we've probably got enough to say that the economy is in a growth path at the moment. Composite was just below 53, it was 52.9, but services was 53.3, down from 53.8 on the last print. But that's updated once every couple of weeks anyway. So let's see, but it looks like the final nail in the coffin for the recession that should never have been called a recession anyway in the UK. So good news overall. But generally speaking, of course, if those PMIs are doing well, that continues to feed services inflation and wage inflation ultimately. And then talked a bit this week about Renters Reform Bill and the likelihood of that getting through Parliament before we're all done. Speculation is there's between about 10 and 16 weeks left of Parliament, depending on when the election is called and when they resit after the summer holidays. Let's see what happens. Will leasehold reform go through? Someone's finally done the maths and said this is going to cost 40 billion in compensation. If we have to compensate the freeholders who are going to deal with massive drops in value of their freehold portfolios, that looks like that's going to knock that side of things on the head. And freeholds going forward can be stopped, which they already have been. But freeholds looking backwards, the system's not realistically going to be fixed. It will be fixed, of course, at one extension because you go to 990 years. But this does not destroy the value of the freeholds in the long run, generally speaking. It will depend where you are in that cycle, but it'd be manageable losses for people who've got a lot of short leases in place or leases under 21 years and things like that, where there are further complexities to be considered. Then we've got the furnished holiday let rules and how that's being changed. I read some interesting stuff about tax simplification in that department and what it might mean for people who've been running FHL businesses, serviced accommodation businesses, various tax reliefs they haven't been claiming that they might be allowed to claim if these rules change, various tax they haven't been declaring that they might have to pay if these rules are changed. Will that happen this Parliament is my big speculation. I'm thinking not a lot of this is going to go through realistically because I don't see a lot of political capital. Renters Reform Bill has been watered down by the rebelling Tory backbench MPs. For the landlord, in my opinion, the average landlord, it would be ideal if it did go through rather than under an Angela Rayner inspired bill, which is going to be a lot more aggressive and a lot more in favour of the tenant. If that happens, then so be it, because you're going to see a bigger sell-off, which means you're going to have less stock, which you're going to see rents go up even more. But you try and make that argument to Angela Rayner and let me know how you get on. Unfortunately, I don't think she's particularly interested in the economic side of it, unfortunately. And so that was the supplement for this week. Also, passing comment on the consumer confidence side of things. So consumer confidence index was slightly improved, but only in the department of personal finances over the next 12 months. It actually printed a positive reading. The index, as I've said before, hasn't been positive since January 2016, but people are reporting a pretty bad last 12 months. They're still expecting the next 12 months not to be so great, but nowhere near as bad as the last 12 months. And confidence is half of the point, realistically. The predictions from 12 months ago actually weren't too far away from what people are reporting happened to them over the past 12 months. So the wisdom of the crowd is usually reasonably good in that department, although at times of crisis or looming crisis, it tends to see it coming. It also shows that people are a lot more bearish these days than they were in times like 1978, 79, which was just before the winter of discontent, really particularly bad time, 1990, 91, before we had Black Wednesday, but during the bottom of the 1990s, early 90s recession, and even in 2008, we had worse print in September 2022 when the pandemic was all over, but of course people were very, very concerned about their energy and what was being said in terms of actually turning the gas on and things like that. That's pretty serious, but I don't think it's as serious as the impact of either the 90s recession or the 2008 Great Financial Crisis, because in both those events, ultimately, lots of people lost their jobs and lots of people lost their houses. And none of that's happened during COVID. So I don't know whether it's just that we get a bit more sensitive as a generation. I don't know if it's because the media are piling in on us more and more with more and more fear. And that was all on the back of the pandemic, where all they did was peddle fear realistically to get clicks. I don't know if it's just a mixture of all of those things realistically, which it probably is. So that was the supplement for this week. Did deep dive into the Bank of England policy report. The minutes are a bit shorter on the alternate meetings where they don't produce a full deck of an inflation report and monetary policy report. Went into them in some detail. If you want to have a look at them, I recommend that you check out that audio file or you check out the written file on my LinkedIn or on the Partners in Property blog. Thank you very much. And if you don't already subscribe to the channel, I'd really appreciate it if you did. Cheers.